Hey, welcome back, folks. I fell in love with budgeting when I went back to school, got my MBA 25 years ago. Um, I'd been working in business, I'd been managing for a long time. We had the concept of a budget, we did strategic planning, but until I really understood the power of budgeting, it just seemed like a task. It didn't seem like it meant anything, it wasn't important. Once I understood how it works and the power it gave me over trajectory, a budget is a plan that you can change as opposed to just reacting to circumstances without considering all the other factors. If we react to the moment, we may make a good decision, but if we're not pulling back and looking at the big picture and incorporating all of our plans, the chances are you're not going to make a good decision. So budgeting is a wonderful, wonderful thing, but gosh, try and get people to do it. So I know that you listen to my words and you take them to heart. So I want to take this week's podcast and dedicate it to opening up your eyes about how the budgeting process works. We're going to wrap this up into a nice little ball for you, help you get started on it. It doesn't have to be difficult. You can sit down and do this in an afternoon for most companies, or you can overproduce it, as many of you will, and have tons of meetings about it. You be you. I want to tell you, here's the down and dirty way to do it and be wildly successful at it and keep your company scalable. Welcome to your weekly dose of uncommon sense, helpful insights, and tough love. I'm your host, Tom Stimson. The Intentional Success Podcast comes to you through the generous support of Mertz Crew.
Mertz Crew helps top AV companies book quality AV freelancers. Your choice, your rates. We handle contracts, insurance, and payments. You save time, cost, and reduce risk. Start today at mertzcrew.com.
Now on to the show. So we want to talk this week about budgeting, and I hope you're not driving. I don't want you to fall asleep or anything. No, this is going to be great. This is something that's very exciting, and I want you to lean in, grab a pencil, make some notes, because there's some good stuff here. Why do we budget? Well, for instance, right now, it's as I'm recording this, it's in October, approaching the end of October. You are probably thinking about next year, but you're really more concerned about this year. Do you know where your end of the year is going to be? Do you know within a few percentage points of what your final revenue is going to be? Do you know what your profit for the year is going to be? And if you don't, that's because you don't have a budget. If you had a budget, you would know, and you're going to be 99% correct. And the 1% that you're wrong doesn't matter. You can predict your cash flow. You can predict how much you're going to owe the IRS, which I know many of you are concerned about right now. You can predict how much money you have available or cash you have available if you want to buy new equipment. You know whether or not you need to hire new people. All of that information is at your fingertips right now if you had a budget. And if you don't, well, we got to get you a budget because I don't want you to be in that spot next year. So let's get out of this whole feast and famine and reactivity of business and using our gut to decide whether we want to drop $1 million and buy a bunch of LED wall because we won one job. No, let's look at our budget and understand how all of this works. So when you sit down and look at your budget, you want to do four things. You want to look at your strategic goals and see if they've shifted. If you have strategic goals for this year that you set a year ago, you need to review them. How are you doing on them? Look at your financial results this year. Okay. Don't budget for next year until you know how well you budgeted for this year. And if your budget was off, figure out what you messed up and get better at it, because every year you budget, the better you're going to get at it. So learn from your mistakes, learn what you didn't know and how to apply that for the future budget, and you'll get better at it. You're going to forecast revenue, which I know is extremely difficult. We're in a seasonal business. Not all of your business is repeat business. I get it. You can forecast revenue. And if it is difficult to forecast, that is also a forecast. Okay, that affects your budget. So if you have unpredictable or unseeable revenue, that's good information. How are you going to use that to run your business? And then the last thing you need to do in your preparation for next year's budget is do an environmental scan. Look around you. Look at the economy, look at society, look at the industry, look at what's going on. And we're going to talk a little bit about each one of these. So let's start with goals. What were your goals for 2025 when you were in 2024 at this time? Right? Did you write them down? Hopefully you did. If you're doing budgeting, you've written some goals down. Hopefully you have some strategic goals. Maybe you're going to grow new accounts. Maybe you were going to expand into a marketplace. Maybe you were going to de-emphasize a segment. Maybe you were going to reduce cost of goods sold. Whatever it might be, you might have been, tactical things like adding employee reviews or reorganizing the warehouse. It doesn't matter what you were trying to do. Did you do it? And if you didn't do it, was it important? Do you need to factor that in? Did you not do it because you were too busy? That would be good information. Did you not do it because it cost money and you didn't have it? That would be better information. If it was in your budget, you can do it, right? So the wonderful thing about budgeting, and I think my aha moment was when I learned that we could budget expenses for projects during slow season and not affect the results of that month. If I knew that we're going to redo the warehouse in July when we're slow, and I took $5,000 every month of the budget and set it aside, and I get to July and I've got $30,000 to work with, and it's not coming out of my July budget because I'm taking it out along the way. I have saved up that money. I've put it away for a rainy day. I've accrued it, use whatever term that you want. I'm not going to not do it because, we're having a slow month. We need to save money. No, I already saved the money. I put it in my budget. So now I have a productive July and I have the money to do that things with. So review your goals. Are you following through? And if you're not, figure out why and use that to change your budget and your strategic plan for the coming year. Now, if you have no progress, what are your next steps? If you completed things, can I replace it and add a new one, right? Go over those goals. Do I need to change the owner of the goal? Do I need to reset a deadline? Do I need to delegate, outsource, prioritize, allocate more budget? Figure out why you didn't do the things that were important to you a year ago and fix the problem that keeps you from doing the things you need to do. Now, financial checkup. I want you to review some finances for a couple of years. You know how much I love trailing 12 months reports. Run a few of those, run the past 3 cycles of trailing 12 months and look at trends. Don't get hung up on the numbers. Look at the trends. Look at the total revenue. There's a neat little feature in every spreadsheet that you use where you can make a chart and map out a trend line. So if you map out your total sales for the past 5 years, for instance, you say, hey, man, we're really growing except that one year. But then you mark the trend line and you find out that we're not really growing. We're actually kind of flat. We just had a good year. Look at trends. Look at trends on your sales, your gross profit, your total income, your overhead expenses, your SG&A. Look at those trends and see how they are tracking. And I'll tell you right now, if you're growing 5% revenue every year, you are flat. You've done nothing. Your revenue is going to grow 5% simply because some of your costs are going up. You're going to raise a price every once in a while. You can accidentally grow 5% even on less business just by charging correctly. So don't get excited about 5% growth. Get excited about consistent year-on-year 20% growth or compound annual growth of 20 or 30% over 10 years. These are things to get excited about, not one-year little bumps or windfalls. Look at the trends, and if you back windfall jobs out of a trend, okay, watch what it does to the trend. How much are those windfalls sucking the life out of your business, right? I'm not saying don't do them. I'm saying be more realistic about what they do to your budget. So if you have a budget already and you're doing this review, look at your year-to-date budget comparison by months. How well are you hitting your budget numbers? If you don't have a budget, compare this year to a prior year. I'd rather compare to a budget and see how well I'm doing. But if you don't have a budget, compare it to a previous year and see what the trends are between those 2 years. Use percentages. Please common size all your P&L reviews. If you have an accountant, bookkeeper, controller who is giving you reports and they don't have percentages on the columns for every line that says what the percentage of revenue is for this revenue stream, for this cost of goods sold, and for this overhead, straighten that person out or fire them. Okay, that is bad management accounting. We need to look at percentages. Now, percentages don't matter below the line that much. All we really care about is a dollar amount. If my average electric bill is $3,000 a month and 1 month is $5,000 a month, I'm going to ask why. I'm going to look into it. No big deal. But generally below the line doesn't change. Cost of goods sold as a percentage of revenue is extremely important KPI, and you need to look at that. Never look at the dollar amounts. Who cares that you spent $5,000 on subrentals? It doesn't matter. What was the percentage of revenue? Okay, that's what's important. Was it $500,000 in subrentals? Who cares? What is the percentage of revenue? Is it within budget? Right. So review your P&L at that level, comparing your results to plan or historical. Now, when you're doing this, look at your revenue for the past year. Was all that revenue planned? How much of it was accidental revenue? Okay, how much of it you knew about coming in? That's going to help you budget forecast in the future. Some revenue is more valuable than other revenue. Now is a great time to have a conversation about that. Some of us think, oh gosh, small jobs are not good for us, but doing small jobs for big clients is, so we can't say that all small jobs are bad. Likewise, we can't say that all big jobs are good. So look at revenue and its inherent gross profit for the type of customer, for the quality of work, for the quality of the experience. Do you want to do more of this work? If you make good money and you like doing that work, try and do more of it. If you make okay money and the customer sucks or the type of work sucks, don't do it anymore. Get it out of your budget. Put some energy to help you replace that. Now, if your revenue's planned, then hopefully your cost of goods sold are planned too. We should know what our subrentals are going to be. We should know what our cost of labor should be because that influences what our pricing is. So if your cost of goods sold is going up and your gross profit is going down, chances are your costs went up and you didn't change your pricing to keep up with it. Wouldn't that be a great thing to find out now when you're trying to figure out what to do for next year? So review that. And then expenses. Looking below the line, are you exercising restraint? Were your hires planned? Your payroll is going to be the biggest number below the line. Were all of the people you hired, were they planned? Did they come in at the time of year that made the most sense? Are you right-sized on salaries? Are all of your expenses planned? Are there any surprises? Hopefully that's a short exercise and then you can move on. Now, review how well you budgeted. Let's talk about variances. If your gross profit varies by 1% up or down, in other words, if you budgeted 50% gross profit for the year and you're between 49 and 51%, pat yourself on the back, you're good. You're well within tolerances. Nobody's going to budget it perfectly, right? Count your blessings. Look at your below the lines, your selling general administrative expenses. That should be within about 2% of the planned spending for the year. Now, if you hired somebody that you didn't expect to hire that was off budget, that's going to affect it by more than 2%. But guess what? Once you hired them, it changed your budget. So you should still be within plan. The 2% I'm worried about is, did your rent go up and you forgot to put it in the budget? Did your utilities go up because you've got leaks all over the warehouse? Things like that. Did your phone bill go up because you forgot to review your carrier expenses and reduce them and renegotiate them? These are the things that are going to give you a 2% variance. And there's a lot of them, and there's a lot of small things to monitor, but they add up to a significant amount of money because 2% of expenses is 2% net profit, right? This is not trivial, but Generally, you can fix expenses one time a year and move on and not have to think about it again. Okay, now the current year is not over. If you're doing this review, you still have a chance to adjust your budget for the remainder of this year, as well as working on next year's budget. Fix your assumptions if your assumptions are wrong. Fix the numbers going forward. You should know how your year is going to end up. You've got to get the numbers in there correctly, and it'll tell you that. If you're having trouble hitting your target net profit number or operating profit number, look at discretionary expenses. Can I reduce some things? Did I accrue some money that I don't need to spend? Do I need to raise some prices between now and the end of the year? What can I do to reclaim some profit that might have slipped away? You still have a little bit of time to do that. Now, let's get on to forecasting, because we're into next year now. How are you going to forecast revenue? Let me give you some general parameters. You have some recurring revenue, you have seasonal revenue, you have contracts and things that you know about, you have jobs you've already sold that fall into next year. You have a lot of data and you have a lot of history. The question becomes, do you need to shoot high? Do you need to shoot low? What's the right forecast that you need to make for your revenue next year? We can't just declare 10% growth and throw a budget out there at 10% growth if we don't know how we're going to grow 10%. Okay. Now, when to shoot high? 10 years ago, I would have probably encouraged you to shoot high. I want you to get ahead of your revenue. I want you to hire before it's too late. I want you to buy equipment before you need it so you can make more money on it. That is not the advice I would give you today. Today, non-scalable companies have to shoot high, or they have to bet on their success in order to keep up with the overhead and costs and all the people that they need in order to run successfully. Non-scalable companies are at a disadvantage, and they will often shoot at a higher budget so they can justify hiring people and buying equipment to keep their costs down. And it's a gamble, and it's a huge risk. Scalable companies do not have to shoot high. Scalable companies can manage far more capacity with the same team and resources. Scalable companies do sacrifice a small amount of gross profit to remain flexible and remain profitable, but they don't have to hire ahead of demand. They can generally handle 10, 15, 20, even 30% more business with the team that they have, okay, if they have a revenue surge. And if it's just a short-term windfall surge, it doesn't affect their overhead at all, right? They just outsource a little bit more, work a few more hours, get through the busy period, and move on. So you can run a lean team in a scalable company. You can outsource the help they need to keep them from getting too burned out when things get busy, but you want them working as far ahead as possible to make everybody's job easier. Okay. Now, shooting low, when do you need to sandbag revenue? Most scalable companies will sandbag revenue a little bit. In other words, they'll project a little bit lower because they don't want to overspend on expenses. They don't want to over anticipate growth. Now, if you have a high concentration of revenue in certain periods, such as windfall business, super busy months, okay, you need to factor some of that out. Those months will happen, but if that's a 20% increase in your total revenue and it's all falling in one period, budget for the lower revenue. You're going to have a windfall, and that is okay. It doesn't affect your budget for the year. It's just a happy circumstance that says we are busier at this time. We had 49% gross profit that month instead of 51% because we had such a concentration of business, and you move on. Now, when the factors that affect your forecast are more uncertain, you do want to shoot lower. Okay. If you anticipate adverse market conditions, you want to budget a lower revenue forecast. Anytime your tolerance for risk is compromised, for instance, you're in a cash flow crunch, you had a major unexpected expense, something's going on in your personal life as a business owner, and you need less risk in your business, budget a lower forecast. Okay. You don't have to beat your forecast to be successful. Your forecast is successful if you execute it because your budget is profitable. Because why in the world would I set a budget and not give myself 20% operating profit? The whole reason we're doing this is that we want to work towards a reasonable profit number. Why not set that profit number in your budget? It's much easier to attend, to get to. Now, why wouldn't I just use most likely revenue? You should use most likely revenue, right? Scalable companies often target their most likely revenue, and they're going to err a little bit on the low side because there's no downside to erring low on revenue. It's easy to scale up if they're a little bit more busy. It doesn't require a lot of effort. Scaling down, however, is problematic. So if you forecast optimistically and something horrible happens or you miss market conditions and your revenue is way down, you've got to scale back. And that's painful. And for a scalable company who has just the right amount of people to do a lot of business, if they have to downsize that business, they're going to lose some key talent because everybody on your team is critical, right? And you have a small team that does more work, and everybody on that team is twice as good. You have half the people that you had before the pandemic, but they're twice as good. They're more expensive. They're harder to replace. We don't want to scale down if we can avoid it. So it's best to be conservative on your forecast. If your forecast is going down, you need to act now. Don't wait to find out if you're right. Trust yourself, trust your forecast. Now, for many of my listeners there who are smaller companies, or you think you're a smaller company, what you will often tell me is that you don't have recurring business. You don't have contracts. You don't really know how much business you're going to do next February. However, you have a consistent track record of what has normally happened, and you have some indicators about our customers buying in advance. It's very possible in smaller companies right now, particularly if you're a regional business, that you have very little revenue already booked for next year. You're 1 quarter away from the next fiscal year. You might have no revenue booked. Don't panic. It's just information. Okay. Your forecasting is always going to be uncertain. You always want to forecast less money. You want to avoid overbuilding your business and getting caught in a shortfall on revenue and having to downscale. So being a smaller company, you have to be more conservative until you get some control over your pipeline and your forecast. What you need to focus on is your break-even number. For the total overhead expense that you have, look at your last 12 months of overhead expenses, divide that by your average gross profit for the past 12 months, and that's going to give you a break-even number. Now, on an annualized basis, it's one number. On a month-to-month basis, it's another. Okay. A busy month, your break-even number is going to be different on a month that's generally slow because your costs are going to vary. So while averaging out for the year says, oh, my break-even every month is $500,000. However, if you have consistent $500,000 months, you're probably not going to make any money. So figure out, you won't make any money because it's break-even. Figure out what the break-even factors are so that when you are busier, the break-even number moves differently than when you're slower. When you are a smaller company, more of your revenue is windfall. Okay. The trigger point for a windfall job is much lower. So if your average order is $5,000 and you have $50,000 jobs, many of those are going to be windfall jobs. If your average job is $25,000 and you have $150,000 and $200,000 jobs, many of those are going to be windfall jobs. Celebrate them, take them, go out there, do a great job, try and get more of them, but don't let that elevate your overhead. Okay. Short-term success, in other words, a good month or a new client, is less likely to change your overall trajectory. Okay. Concerted, recurring, consistent effort on growing your pipeline will. So a one-time success is a windfall. Consistent success, now we can start building into that business. So revenue in a smaller company is correlated to your outbound sales effort. If you're not doing outbound sales, you're not going to move the needle. Figure out what's going to move the needle for you. Now, the last thing we want to take a look here is the environmental scan. You need to look around the world, see what's going on in the business, what's going on in your industry. There's more information available to you than you think there is, right? Look at your supply chain. How busy are your subcontractors? How far out are your favorite freelancers booked? Just ask them. Okay. The farther out they book, the better the economy looks, the more positive you can be, or the more concerned about your lack of pipeline you might need to be. Look at your suppliers. Are their costs trending up? Are they announcing price increases for next year? Okay. Why? Understand what's going on because that could affect your business. Look at the competitive landscape. Talk to the hotels. Look at the Convention and Visitors Bureau. Are the facilities booked? What's the activity in venues? You may not work in those venues, but if your city has a lot of business going on that's booked into the facilities, particularly public facilities, that's good information. If they have no business, that is also good information. Look at your competitors. Look how hard they're marketing. Look at the products and services and things that they're talking about. Okay. Yeah, some of it may be bluster, but the fact is there's a lot of truth behind marketing. Otherwise, it doesn't work. So maybe we should pay attention to that. Okay. Verify your sources of info. Do not take third-hand anecdotes for somebody and put that into your meeting. That's a waste of time. Dig down into it. Talk to more sources. Network with people. Talk to other business owners. Talk to customers. Find out what's going on. How are they feeling about budgets for next year? Just get some information and let that affect your future budget. So, are you seeing disparities between what's going on in the industry and what is going on with you? Maybe you need to look internally to see if there's some things that you need to work on to fix your problems. Do you have some advantages out there that you need to leverage? In other words, are you seeing opportunity? Is there something that you can do strategically that will help you take advantage of it? Now's the time to be talking about that. So, just to summarize, verify what you know about budgeting today and get better at it every year. Remember that the only real variables are total revenue and your revenue mix. Everything else tracks. I can make adjustments to cost of goods sold, but for the most part, it tracks and it's going to move very little. I'd rather move revenue than try and spend too much energy reducing cost of goods sold. Fix my revenue mix is going to put more money to the bottom line than nickel and diming suppliers in your supply chain. And use industry observations to adjust your revenue forecasts and maybe even some of your cost projections because revenue may be down and costs may be up. Now would be the time to be thinking about that and making adjustments into how you sell. So there you go. I hope you're still awake. I hope you get something out of this, but there's a lot of value in this. It's a big topic. It's worth time and energy. My Intentional Success Club members understand this. They talk about this all the time. We look at forecasts, we look at revenue, we look at KPIs, and we talk about these numbers. If you want to look at your numbers in a more healthy way, a more intentional way, give me a call. Let's see if you're a good fit for one of my clubs, and you can learn from your peers as well as learning from me. Thanks for listening. Get that budget going.
If you liked this episode of the Intentional Success Podcast, please leave a review and don't forget to like and subscribe. This podcast has been brought to you by the helpful folks at Mertz Crew.